This week on Dialogue, the quarterly report, Rethinking the Great Recession. Welcome to the Woodrow Wilson International Center for Scholars in Washington, D.C. I'm John Milewski. Each week, Dialogue explores the world of ideas and issues in international affairs, history, and culture. And once each quarter, we take a look at the latest issue of the Wilson Center's flagship publication, the Wilson Quarterly, with the help of its editor, Steve Lagerfeld. Steve, welcome back.
John, thanks for having me back.
We're also joined by a contributor to the current issue. Robert Samuelson is a columnist for Newsweek and the Washington Post. He's the author of several books, including his latest, The Great Inflation and Its Aftermath, The Past and Future of American Affluence. In the current issue of the Quarterly, he wrote the piece, Rethinking the Great Recession. Welcome to the program, Bob.
Nice to be here, John.
Steve, tell us about the current issue. I'll hold it up for our viewers to get a look at the cover.
Well, John, on the cover, you'll see the 7 million. That's the number of people who are either in jail or elsewhere in the correctional system in the United States. It's a lot of people. And the crime rate has been going down. The incarceration rate has been going up or staying steady. Recidivism rates have not improved ever, really, and as long as we know. And we can no longer really afford that high level of incarceration. And our 3 articles in this issue deal with that sort of conundrum and all the research that's been done on criminal recidivism and what goes on in prisons and the criminal justice system. This is very timely and topical. I was pleased to see right after we went to press that Newt Gingrich appeared in the Washington Post with another author announcing a new organization called Right for Crime, Right on Crime, I guess it is. And they were making many of the same points and argued in the piece that the time is ripe, really, for a sort of left-right convergence on this issue, mainly due to the overwhelming expense of policies that are paying diminishing returns. Also in there, we have some wonderful pieces on the Balkans. 20 years after hostilities broke out there, we see a glimmer or maybe something more. Indonesia, a surprising success story. Democratic, Muslim-majority country, doing really quite well economically as well. One of my favorite pieces in there, personal favorites, is a piece on trees. Piece on the new science of the value of trees, and especially urban trees, putting a price tag on how much they supply us in terms of sucking in pollutants, catching rainwater and other benefits, and making us feel better. And this research is having a big impact on the drive to sort of reforest cities. A lot of cities have sort of taken up this research and used it to do work in their own areas. Now, of course, our headliner in this issue is Robert Samuelson.
Rethinking the Great Recession. Last issue, we talked about China's economy and how it fits into the global economy. Now we turn our attention again to the economy. I guess I can't get enough of that these days. You've been writing about this for a long time.
Maybe too long.
Maybe too long. The first thing I want to ask you, Bob, are you comfortable talking about the Great Recession in the past tense? Do you feel we're comfortably into a recovery?
No, and I think that the nomenclature that economists use in dating business cycles and specifying periods when the economy is expanding and when it's contracting, and calling the latter recessions and the former business expansions, it's a little bit artificial in the sense that it's totally driven by statistics. And so that if you have a very deep recession, as we had, if the economy begins to come out of the recession but still is in a state of misery, it's called recovery. It's called an expansion, and that's a sort of an academic term, but we still have 15 million people more or less unemployed. The unemployment rate has hardly come down at all. We lost 8 million jobs during the recession. We've gotten, the last I saw, about 1 million of them back. Something like 40% of the unemployed have been unemployed for more than 6 months. So from a the point of view of most people, the recession isn't over yet. If by recession we mean a period when the economy is not doing very well.
It almost sounds as if we apply the terminology to make something chaotic sound more orderly than it really is.
Well, economics is sometimes posed as a science, and when it really isn't.
Yeah, yeah. Well, you frame this by talking about an American impulse to turn everything into a morality tale. Explain that notion of looking for blame in the.
Well, when we have a crisis or a big problem, the political instinct, the political impulse, I would say the journalistic impulse, and even the intellectual impulse is to sort out the good guys and the bad guys, to find out who caused the problem and how it can be cured, and to some extent, if the causes of the problem seem suspect or morally reprehensible, to convict these people either in a court of law or the court of public opinion as being antisocial. And that's the process that really started with the financial crisis in 2008, and it continued during the period of the recession, and it continues today. We really want to find out who are the bad guys, who are the villains.
Could you briefly give us the two narratives from each of the political camps, the right-left camps? What are the narratives when they interpret what happened to create the Great Recession?
Well, the left basically blames Wall Street and greed and the impulse to deregulate the economy, which they say arose during the 80s and 90s. And so that you had all these greedy Wall Street types doing all these things that were ultimately unsustainable, and there was no cop on the beat. There was no regulator to say, don't do that, because if you continue doing that, not only are you going to lose a lot of money, but you're going to trigger a major financial and economic crisis that will bring us all down. So that's the left's explanation. The right's explanation is that through a variety of interventions in financial markets, the government conditioned financial markets to be irresponsible. They bailed, going back to the 1980s and through the 90s and even early into this century, they bailed out investors and financial institutions when there were problems. They encouraged Fannie Mae and Freddie Mac, which are these two large quasi-government agencies and part private companies. They were private companies, but created by Congress to invest in housing and home mortgages, and that according to the view of the right, by their irresponsible behavior, they pumped up the housing market and created the housing bubble. So you have these rival explanations. On the left, it's the Wall Street greedy types who were basically not watched by government, who pump up the housing market, issue an awful lot of bad mortgages, which ultimately default, bringing down financial institutions, creating this huge housing bubble, then bringing down financial institutions that invested in these things. And on the right, you have the same process, but the causes of it are the government intervention in the markets that promoted housing through Fannie Mae and Freddie Mac, and also the rescue of investors periodically when they got into trouble, which created, in the right's view, a kind of heads I win, tails you lose situation where they reaped the profits of gambling and irresponsible behavior, but the government bailed them out when they failed.
Bob, one of the interesting points you make in your piece is about regulation, and that's part of the argument about what happened, that regulators failed, that there weren't enough regulations, there weren't proper regulations. But in your piece, you argue that, in fact, there were plenty of regulations.
Well, the problem with the left's explanation is that many of the institutions that were at the center of this were, in fact, regulated. All the banks, Citicorp, Wachovia, JP Morgan Chase, they were all regulated. To a lesser extent, the investment banks, Bear Stearns, Goldman Sachs, Morgan Stanley, Merrill Lynch, they were regulated. There was regulation of mortgage. Now, there were gaps in the regulation. There's no doubt there were gaps in the regulations, but there were enough critical junctures in the financial system that were regulated that if the regulators had realized what was going on, they could have stopped this process. It's not as if if you listen to the rhetoric on the left, you would think the entire financial system had been unregulated. had been deregulated, but that just wasn't the case.
One of my favorite, I haven't really read much about this, but one of my favorite points about this whole subject is that before the crisis, some of the most troublesome companies, Washington Mutual, Fannie Mae, et cetera, there's a long list of financial companies, were actually favored choice investments of so-called value investors, the followers of Warren Buffett. He himself, as you point out, acted wisely in this case, but those stocks were touted by people who prided themselves on, attention to what was really happening, numbers, book value, hard values, not growth and sort of vociferous things. They love those companies, and many of those companies are gone now. This speaks, I think, to our ability to see what's going to happen, to look
or our
into
inability
the future.
to see what's going to happen.
The prevailing view before the crisis was that investing in home mortgages was a very safe investment because you had the collateral of the home to back up the collateral of the house to back up the loan in case the borrower defaulted. And the notion that existed before the crisis was that housing prices would go up forever. And therefore, therefore it became respectable and responsible to make loans to people who earlier would have been considered bad credit risk, because even if they defaulted, you would have the value of the home to pay back the lender, and the value would go up. There was also a theory that if people took out mortgages that seemed to stretch their ability to pay, they could refinance after 2 or 3 years because the value of their home would have gone up, and it would be a safer loan to make for the lender. So there was a series of propositions that were widely accepted by the people who were lending the money, to some extent the people who were borrowing the money, and also the regulators. The problem was not that there was no regulation. It was that the regulators believed the same optimistic stories that the people that they were regulating believed.
In the piece you write that it wasn't the absence of regulation, it was that regulators were no smarter than the regulated.
Yeah, and that is one of the problems with counting on regulation to bail you out.
Well, let's be equal opportunity deconstructors here now that we've taken away the central premise of the left's argument. You also say that this notion that the government made me do it is an even weaker argument.
I don't find this very persuasive, because the argument is that somehow the government protected investors against losses and therefore conditioned them to become reckless as opposed to kind of prudent and risk averse. Well, if you go back and look and ask when did the government bail out investors, you don't come up with very many instances when this happened. It is true that in the 1980s, in 1984, the government bailed out Continental Illinois, which was at the time was the 7th largest bank. But the shareholders lost 80% of their value in that. The managers got kicked out. So although it was true that the institution was saved, the people who had invested in the institution as shareholders and the managers who got their livelihood from it, they lost out completely. There were other instances when there was a hedge fund in 1998 that was rescued not directly by the government, but the government organized a rescue. But the same thing happened there. The original investors lost almost all their money. They lost their jobs, basically, and to a large extent, they lost their reputations. After the so-called tech bubble in the 1990s, where you had all these dot-com stocks that went to astronomical heights and completely irrational valuations, the stock market declined 50%. So stock investors were not bailed out. And even if there were a couple of instances when investors were rescued, but there were only a few of them. Mexico had a debt crisis in 1994, and foreign investors were rescued then. But even considering these, it was impossible for anybody to know in 2007 and 2008 who was going to be rescued and under what terms. And if you actually look at the record, the truth is that most of these institutions were not rescued in the sense that I said earlier. That is, the institutions may have been preserved. Bear Stearns, an investment bank, was purchased by J.P. Morgan Chase, merged into J.P. Morgan Chase. but at almost, it was $10 a share ultimately. So the shareholders lost almost all their money, and the officers in the company lost their jobs. And since most of them were invested in the company, they lost a large chunk of wealth. And you can go down the list. There just wasn't all that much rescue of investors.
I guess this is the formula that says there can be such a thing as too much optimism within.
Well, my theory of the financial crisis, which is, I have to say, sadly, is not the mainstream theory, and it seems to be embraced by very few people except me, is that we went through an old-fashioned boom and bust. And sort of building on my book, The Great Inflation, I argue that the decline of inflation in the early 1980s really triggered a 25-year economic boom, during which there were only two very modest recessions in 1990-91 and in 2001, in which the stock market's value increased more than tenfold, in which housing prices began to rise substantially. And the reason for all this was that as inflation came down in the 80s and the 90s, interest rates declined enormously. So at the beginning of the 80s, if you wanted to take out a home mortgage, you'd have to pay 15-16% for a 30-year mortgage. By the end of the 90s, that rate was 6%. It's now even lower. And so as interest rates came down, people could afford to pay more for their houses, and so housing prices went up. As interest rates came down, people took money out of bonds, put them in the stock market, and so you got this huge stock market boom. And as people felt wealthier because their housing values and their stock portfolios were going up, they spent more, so we had a consumption boom. And so for 25 years, we had this enormous economic expansion, and people began to take it for granted. We would have recessions every once in a while, and we might have problems in financial markets, but the assumption that accompanied this was that the Federal Reserve and the Federal Reserve is a so-called central bank created by the government to help manage the economy, that the Federal Reserve could take care of major crises and avoid them, and that other central banks in other parts of the developed world could do the same thing. So economists call this episode, this 25-year, the Great Moderation, because we no longer had the really severe recessions that had occurred to some extent earlier in the post-World War II period, and certainly had occurred before World War II.
Any notable canaries in the mine shaft that you can remember now, looking back with a chance to reread the record?
You know, there were a few economists who were worried. Nouriel Roubini has since become very famous for saying we are in for a lot of trouble. There were a few economists at the Bank for International Settlements in Basel, Switzerland, who said what we're getting here is an old-fashioned financial inflation of financial assets, stocks and bonds, and it won't last, and it's going to collapse. And we need to be careful about this. Warren Buffett, although he did not see the housing crisis coming, and in fact invested in Moody's, which to some extent has been blamed. It's a rating agency, and they rated a lot of these securities. So Buffett invested in this company. But he did warn about the dangers of financial derivatives, which are these very complicated securities that exacerbated the business and financial crisis. But all in all, there weren't all that many, and there were a number of hedge fund people who said these mortgage-backed securities, which were at the core of the housing boom, are going to collapse in value, and they bet against them, and they made a lot of money. But even with all these exceptions, the vast consensus shared by mainstream economists, by business executives, by bankers, and by regulators was that we had entered a period of much less instability, and as a result of that, we didn't have to be as careful. Because the world was less risky, to some extent we could take more risks.
Where was your thinking pre-bust?
Well, I would like to claim that I saw it all coming. I did not. At the end of the 90s, I was one of many people who said about the stock market, the dot-com boom, this cannot go on, this is completely crazy. And so I called that. And I did write a couple of articles, columns, saying the housing market looks like it's out of sync, that its prices have gone too high. But these were tentative columns. I also presented the opposite point of view that said, quoting housing experts, no, these prices are sustainable and stable. But even if I had been more emphatic, what I did not see, and I have to say neither did Alan Greenspan or Ben Bernanke and a whole bunch of people who are a lot smarter than I am, what I did not see was the kind of chain reaction, that the housing market would collapse, that would bring down the prices of these mortgage-backed securities, that the mortgage-backed securities were then held by a large number of financial institutions and people would not know whether they were solvent or not. So there would be a kind of rush away from lending to established financial institutions that would create this lending crisis in the financial system whereby normal channels of lending became clogged. So you had this kind of, again, this domino effect, and I didn't see that at all coming.
It has me thinking, Steve, what happens next? I mean, if we didn't see this coming.
Well, and not only what happens next, but how do you even recognize? There are a few canaries in the coal mine, to use John's term, and there's always people out there predicting disaster or success.
Absolutely, yeah.
How do you recognize those people, and now?
The answer is I really don't know. I think, though, that there is a lesson here that people don't want to hear, but which I think has really been a lesson of the post-World War II period. And that is that there is a great contradiction at the core of democratic, and I don't mean Democratic Party, I mean democracy, democratic economic policy. And that is that the quest and the goal of economic policy in our society and in most democracies is to create as much prosperity for as many people for as long as possible. People want economic growth forever. They want to get living standards rising forever. They want prosperity to be a permanent condition. And our economic policies really strive to do that. But when we strive to do that and when we succeed, we actually create the seeds of our undoing, because people become so optimistic that they become reckless. They become complacent and careless. And this has happened several times in the post-World War II period. It happened in the 1960s when economists came and said, we can manage the business cycle, and by lowering interest rates or raising interest rates, by increasing or decreasing budget deficits, we can stimulate or restrain the economy, and we can get rid of recessions. And the only thing they got rid of was, they didn't get rid of the recessions. What they did is they just created inflation. And then we had rising inflation from the end of the mid-60s really to the end of the 70s and early 80s, which was tremendously destabilizing for the economy. And the same thing happened in the the disinflation period that began in the early 1980s. We thought that the Federal Reserve had solved the problem of creating constant growth and that we weren't going to have any recessions. And so I've argued the very unpopular and I would say anti-political view is that we ought to be more tolerant of recessions, that if we have more frequent but milder recessions, they may help us avoid these less frequent but really terrifying and destructive economic convulsions of the type we're having now.
And what does that mean in real terms? When you look back at what economic growth really was, it wasn't like we were growing like gangbusters. 3.5% during the Clinton years or the Reagan years.
And also, I'd add, what does it mean in terms of unemployment? What would be a tolerable recession as your friend?
Well, I would say, you go to 6, 7, even 8% unemployment. Nobody likes this, but it is a lot better than having 9 or 10% unemployment for now over 2 years, with 40% of, as I mentioned earlier, 40% of the unemployed 6 months or more. If you're out of the labor market, you're losing skills, you're losing contacts, you're losing credibility. So it becomes much more difficult for people to get jobs, or at least jobs that are anywhere near the incomes that they lost. And so it's a choice. In my view, we have to acknowledge we live in an imperfect world, and we have to deal with it the best we can and not try to create a utopia in the economy, which is so far has proven impossible.
How has this shaken your confidence in our ability to predict?
Quite a bit, because and I have to say I blame professional and particularly academic economists for being out to lunch. They, in their models, really did not incorporate financial instability into the business cycle. If you look at your standard introductory textbook in economics, you do not find economic models that describe what happened to the United States in 2007 and 2008. There's just not a central place in the theory up until then. I won't name him, but I called a very well-known economist who has written a fabulously successful economics textbook. And I said to him, don't you think you have something missing here, that you really haven't paid enough attention to what's going on in the economy? And he said, no, not at all. And he called me back a day or two later and he said, well, maybe you're right. This is the kind of denial. An economist, I made this call in the early phases of the crisis before it was as severe as it became. It became so severe and the lapses are so obvious that now most economists are admitting this. But I think that that the big casualty here is not, as the conventional wisdom would hold it, capitalism, because capitalism has been regulated really since the 1930s and it will continue to be regulated. The real casualty here is our faith in economics and economists and their ability to understand and predict what the economy is going to do.
Robert Samuelson, thank you. Steve, before we sign off in about 20 seconds, can you give us a quick preview of the next issue of the Quarterly?
Well, we'll have a cover story on the future of American cities with some wonderful pieces by Tom Vanderbilt and Witold Rybczynski and other notable observers of the city scene. Questions about can you really have a city that lacks industry, for instance, and a whole bunch of interesting questions like that.
Okay, well, thank you. The book is The Great Inflation, available in bookstores and online. And here's the latest issue of the Wilson Quarterly. We'll return next week with another edition of Dialogue. Until then, for all of us at the Wilson Center, I'm John Milewski. Thanks for joining us.
We'd like to hear from you. Please send your questions or comments to dialogue@wilsoncenter.org. You can also follow us on Facebook. Search Dialogue Radio and Television. Our host Twitter feed is twitter.com/John Milewski. Dialogue is a co-production of the Woodrow Wilson International Center for Scholars and MHZ Networks. Dialogue is available via broadcast, cable, satellite, and telco on MHZ Worldview throughout the United States. To see how to watch where you live, visit www.mhznetworks.org.